In this video, I'm going to discuss absorption costing versus variable costing. And absorption versus variable refers to the format in which an income statement is presented. So if you look at this side here, I have the rest covered so that we can focus on the absorption. We have a sample of absorption costing format for an income statement. You will notice that it has sales, cost of goods sold, gross profit. Gross profit is sales minus cost of goods sold, and whatever you have as gross profit is used to cover selling and administrative expenses. Okay, this is a very simple example in which the gross profit is $400 and the operating expenses is $300, so our net income is $100, and we sold 1,000 units in this example. Okay, so if you recall from the financial accounting chapters, this was the format that we used in financial accounting. This format complies with GAAP, Generally Accepted Accounting Principles, and it's the one that's required by the SEC and the FASB. And this is the format that you will find in annual reports and so forth. Okay? Cost of goods sold are known as product costs, and the period costs are all operating expenses, selling and administrative. The book also includes research and development. Okay, so if you want to get a little bit more details on these costs, I have two other videos out. One of them explains cost behavior, and the other one explains the product cost flow. How do we derive the cost of goods sold? We'll take a look at the product cost flow video, and you will get an idea of how we derive that the cost of goods sold. I explain it all in that video. Okay. I also have another chart called the cost classification chart, which tells you the specifics of what flows into each of these categories. Let's take a look at that. So this is the cost classification chart. Product costs, which flow into cost of goods sold, are initially capitalized into inventory, right? So these are all capitalized into inventory. Direct materials, direct labor, and factory overhead. Okay? And capitalized means that it doesn't hit the income statement. It goes into inventory, which is part of the balance sheet, as you can see here. And when you sell it, it then goes into the income statement as part of cost of goods sold. Okay? On the other hand, period costs are expensed immediately. When you incur period costs, it doesn't hit the balance sheet. It goes straight into the income statement as an expense. And as you know, revenues and expenses affect net income or profit, which is one of the biggest categories that investors are looking at, right? Okay, so let's go back to absorption versus variable costing. So we have the absorption format again, which includes cost of goods sold and selling and administrative expenses. One of the biggest problems with this format is that we can't do a lot of the most basic analysis in managerial accounting. I like to use the example of break-even analysis, but there's other analysis that we really can't do. Why can't we do those analysis with absorption costing? Well, if you look over here, cost of goods sold has both variable and fixed components in it. Okay? Let's go back to the cost chart. You can see that direct materials is variable. You can see that direct labor is variable. But factory overhead has both a variable and a fixed component. You also have a variable and a fixed component in the period cost, selling and administrative. Okay? The variable in the period cost, selling, I have two examples here. There could be others, shipping and sales commission, right? In factory overhead, we have some variables, for example, which are the utilities, heating and lighting the factory, miscellaneous supplies such as glue, for example, the cost of oil to lubricate the machine, and then you have fixed mixed up with that. Property taxes, insurance, and so forth. So you have a mixture of variable and fixed here. You have a mixture of variable and fixed over here. And that's a problem if you can't distinguish the fixed from variable, because a very simple analysis like a break-even analysis you can't even do looking at this statement. Okay, so how do we fix that in managerial accounting? Managerial accountants go from absorption to variable costing. So one of the first things to do that is to identify the different type of costs. Okay, so let's move a little bit this way. So the first step that you want to do is you want to identify the costs of goods sold, which ones are direct materials, which one are direct labor, how much, and how much is factory overhead. You'll know that information, or you should keep track of that information when you do the, let's see if I could scroll over here. When you do this process here, you'll know of what you sold, how much was sold in materials, how much was part of direct labor, and what was part of factory overhead. Okay, so I'm not gonna go into the details of this. We have a video on that already. But let's say you were able to decompose the cost. Direct material was $100, direct labor was $100, and factory overhead was $400. $100 of which was composed of variable. Let's say something like factory utilities, because utilities go up as production goes up, right? And 300 was fixed. So now you've been able to identify your different categories that fall in here. And as we know, direct materials is a variable cost, right? Because you spend more materials as you sell more inventory. Direct labor is a variable cost because you're gonna increase labor and spend more money in direct labor as you sell more inventory. Factory overhead, an example of variable costs would be utilities, right? You're going to spend more utilities as you produce more and sell more. Fixed, examples of fixed for factory overhead would be something like the supervisor of the factory. His or her salary tends to be fixed, right? They get a fixed salary, so they don't get paid more if they spend extra hours in the factory. They get paid the same thing. They don't get overtime. Insurance for the factory is another example of fixed, right? Insurance is going to stay the same. It's a flat fee regardless of how much you produce or sell. Factory rent tends to be fixed, right? If it's $10,000 a month, it doesn't matter if you produce 1 unit or 1,000,000 units, you're going to pay the same exact rent. So we've decomposed cost of goods sold into its different categories, and the main goal here that we're trying to accomplish is to identify which costs are variable and which costs are fixed. And you're going to see how this information is useful in later on in this video. Okay, you have to do the same thing for this category. This category, operating expenses, which are the period costs, include selling, administrative, and it could also include research and development, which I don't have here. Okay, so you're going to identify which ones are variable and which ones are fixed. In my example here, I said, okay, the selling has variable cost of 100, which consists of shipping and sales commission. Okay, and it has $50 of advertising. Advertising is fixed, right? Because if you enter into an advertising campaign, you say, okay, my advertising campaign is going to cost me $50. And it doesn't matter if you sell 1 or you sell 1,000,000, you're still going to pay what you agreed to pay on the advertising, right? Administrative expense that consists, so selling consists of things like shipping, sales commission, advertising, marketing, etc., etc. Administrative is most of the administrative stuff. Think about this as things in corporate headquarters, whereas this over here is things in the factory, right? Even people in the factory, like factory supervisor would be factory overhead, fixed. Okay, but the CEO salary, that's a fixed salary, right? But it's part of administrative. Okay, Factory rent is factory fixed. That goes up here as part of a product cost. It's capitalized into product. Corporate headquarters rent is an administrative expense. Okay, it goes down here. Same with depreciation. Any depreciation that is in assets, fixed assets in the factory goes over here, right? And it's fixed. If you use units of output, then you could claim that it's variable, but let's not complicate things. Any depreciation in machinery or equipment in the corporate headquarters would go down here, okay? So typically I'll just give you the majority of this information, the breakout, okay? So now you have the breakout. So now we want to change this absorption format and convert it into a variable format. What we're going to do is we're going to shift anything that's variable up and leave the fixed on the bottom. And we'll see right now as I move this and take this to the side. Okay, so this is the variable costing format. Okay, I'm not 100% sure why this is how I'm going to test it. I'm going to put all the variable costs into one category. Okay, let's see if I break it out here. No, I don't break it out here. Okay, so typically in the I'm just going to show you this very quickly in case you see it in the slides. You will have it more like this. You will have sales. You could see it like this as well. Sales 1,000. Then you will have only product variable cost. Okay, product variable cost. And let's say product variable cost is, well, I have it right here. Let me just do it here. 300. Okay. This is what we call. Let me try to make this nice and neat. Let's go ahead and. Okay. This is what we call the manufacturing margin. Manufacturing margin. Okay, so my manufacturing margin is nothing more than 1,000. Excuse me, wrong. It's nothing more than 1,000 minus 300. Okay, so my manufacturing margin is 700, and then we put selling and administrative variable costs, and that is going to be, so this is one line in and of itself. Okay, let's just give this a little bit of a, just so you understand that this here, did I do that? Okay, so that's one line, and then you could subtract selling and variable, which would be right here, 100. Okay, and then you reach your contribution margin. Okay, which is nothing more than 700 minus 100. So my contribution margin is 600, okay? As you see here. This is the same breakout. I just put variable costs together. I combine these two, and the reason I do that is because it simplifies the explanation. Most of the analysis you could do it using this format. But the official format breaks out product costs with selling and administrative variable costs. At the end of the day, the most important margin that we want is the contribution margin, okay? And you'll see how that's going to be useful in analytical stuff. But if you encounter this in the PowerPoint slides, now you know why. Okay, so we have sales of 1,000. That's going to be the same as this here. For the variable cost, we're simply going to take all our variable costs, direct materials, direct labor, and the variable portion of factory overhead, plus the variable portion of selling and administrative, and put it there. This tells me that this is all my variable costs. So my contribution margin is $600. $1,000 in sales minus variable costs gives me a contribution margin of $600. So what does this contribution margin contribute towards? Well, it contributes towards covering fixed costs first, right? The fixed cost is fixed product cost, which factory overhead is a product cost, right? And fixed period cost, which we already identified as $200. Notice that the net income is the same in both statements, okay? Net income is always going to be the same in both statements. It's the same statement, you're just rearranging the data, okay? So contribution margin first is used to cover fixed expenses and then to contribute towards net income, okay? We can also express, this is total dollars here. We can express contribution margin in percentage terms, right? So I have a contribution margin of 60%, right? That's calculated simply by taking the 600 and dividing it by 1,000. Contribution margin is 600 divided by 1,000. 0.60 is the equivalent of 60%. Let's come over here and there, and if I click the percentage, you're going to see that it's 60%, okay? Notice that the contribution margin relates to sales, so sales is always going to be 100%, and the variable cost relates to sales. So if variable cost is 40%, contribution margin has to be 60. These two have to add to 100%. So if I told you variable cost is 55%, what is the contribution margin? Well, the contribution margin is going to be 45%, right? Because they have to add up to 100%. Okay, and this data can be used for analytical purposes as well. Okay, could be used for pricing decisions as well. Okay, so let's you could also translate this into on a per unit basis, and that's also very important for analytical basis. If I sold 1,000 units, you see I have sold 1,000 units, and I made $1,000 in sale, then I know that I sold each unit for $1. Although I sell the unit for $1, that's not really the net that I make per unit to cover fixed expenses and contribute towards operating or net income. Why? Because it cost me 40 cents to produce and sell one unit. Okay, I can avoid this 40 cents. It's materials for the inventory, it's direct labor, it's all the variable cost that is directly associated to the unit. Okay, so every time I produce one unit, my costs increase by 40 cents. And in turn, as you know, when I sell it, I recognize that cost. So every time I sell a unit, I recognize those costs, okay, those variable costs. They're directly linked to the product. Also directly linked to the product is sales commission and shipping. Every time I sell a unit, in this case, let's assume that the shipping, the shipping is directly linked to the product, okay? So every time you sell a unit, you're going to have some shipping or sales commission, right? So you can avoid these costs, okay? So there's 40 cents. So really you get 60 cents per sale to contribute towards your fixed expenses. Once you cover your fixed expenses, this 60 cents goes down to your bottom line, net income, on a per unit basis, okay? So let's see how this information is much more helpful now. As you recall, I told you that I can't use this for doing something as simple as a break-even analysis because I don't even know what my variable cost is versus my fixed. That's very important for doing something as simple as a break-even analysis, okay? So let's go back and take a look at this. Okay. So now I have it in variable format, and let's see the type of information that I can now do by having it in this format, okay? Why this information? With this information, we can answer very quickly questions like these, okay? How much will operating income change if sales increase by 8,000 units? Well, that's pretty simple, right? How much is going to change if I increase sales by 8,000 units, okay? If you don't understand things correctly, you say, well, I sell each one by $1, so my sales should increase by, operating income should increase by $8,000, right? You would simply go 8,000 times $1. So, but that would be wrong, right? Because each one of these incremental units that you sell for $1 is also going to increase your expenses by 40 cents. Because as you produce and sell these units, you are increasing your variable cost by 40 cents. So in reality, each of these units only contribute 60 cents to your bottom line, right? So the right answer is to take 8,000 and multiply it times 60 cents, not $1. So my operating income will increase by 4,800. So if I sold 8,000 units instead of 1,000, I would have net income of $4,900, right? I would go ahead and add 4,800 to my bottom line. Okay? So I was able to answer that question very quickly by understanding that each unit contributes 60 cents to the bottom line. Let's say somebody walks up to you and says, okay, I have, by the way, you'll notice that these numbers don't necessarily match. I have 1,000 units sold here and 8,000 over here. That's a humongous increase, right? But just bear with me there. These are just numbers to help explain things, and I try to keep them as simple as possible. So let's take a look at another question. If you are offered an advertising program costing $55,000 and expecting to generate $90,000 in revenues, should you accept the deal? In this case, the per unit basis is not that helpful, right? The data that is most helpful is the percent basis, okay? 60%, and you'll see how. Okay, so a mistake would be to say, okay, I generated 90,000 in revenues, and it's going to cost me 55,000 in advertising expense. So yes, let's accept the deal because I'm going to make $35,000 profit. That would be wrong, right? Of the 90,000 in revenue, you only get the net that you keep to contribute towards fixed costs and then to fixed costs and then towards income is 60%, right? Because it's going to cost you 40% of your revenues in incremental variable costs, okay? So to generate in other words, to generate the extra inventory to create this $90,000, you are going to incur an extra 40% in costs, okay? So let me do it down here really quickly. If I generate an extra $90,000, okay? Let me change it. Let's see. I like to have this nicely formatted. If I generate an extra $90,000 in sales, right? My variable cost is not going to be zero because I need to spend some money to generate that extra inventory and sell it, right? Remember, I need direct materials, I have shipping expenses and so forth. How much is that going to be? Well, that's very simple to determine. It's going to be 40%. So my variable cost is going to be 90,000 times 0.4, 36,000. So that my contribution margin is going to be 90 minus 36. Another way to do it is very simple. You can bypass this whole step here and you can say my contribution margin is 90 times 0.6, right? That's going to be 54,000, same number. My contribution margin is 54,000 under an incremental income, increment under the scenario of accepting the advertising program. But the advertising program is going to cost me 55,000. So I'm actually going to end up losing. This is based on estimates, right? You project a loss of 1,000 if you accept the advertising. If you accept this deal, it's not a good deal, right? So I could do this very quickly in my head. I take a look at the advertising agent tells me, oh, you're going to increase revenue by 90,000, and I'm going to very quickly say, okay, I increased revenue by 90,000, but my margin is 60%, so I'm going to, but my margin is 60%, so my contribution margin on that revenue is going to be 54,000. It's going to cost me 55,000. The answer would be reject, right? Because you know you're going to lose $1,000 in this deal. Okay? You could also calculate break-even points in units and in revenues. So what's my break-even point here? Okay, break-even point is very easy. Break-even point is the point at which you cover your fixed costs, right? Because at 0 units produced, you still have fixed expenses of $500. Fixed expenses don't go away. Each unit contributes 60 cents. So how many units do I need to sell to cover my fixed expenses? Well, that's very easy to calculate. You simply go, I have fixed expenses of $500. Let me divide that. Each unit contributes 60 cents. So how many units must I sell? 833 units. If I sell 833 units, I cover my fixed costs, right? Because each of those units is going to contribute 60 cents, which means that each unit contributes, the total dollar contributes is going to be $500, and my fixed expenses is 500, right? So at that point, I break even. My revenues match my fixed expenses, and that's my break-even point in units, 833 units. Okay? What's the break-even point in revenues? Well, that's very easy. Well, in this case, it's the same thing, right? Because each unit costs $1. So not the same thing, but it's expressed in dollar terms. So if the break-even point is 833 units, and each one sells for $1, then the break-even point is going, in dollar terms, is $833. Let me put the dollar sign here, okay? So this is units and this is dollars. If the break-even point was $833 in units and you sold each one for $5, then it would be $4,165 as far as revenues goes. Your break-even point in dollar terms is $4,165. So to get the break-even point in dollar terms, all you have to do is take the units that you have to sell and multiply it by the unit sales price, and you'll get the dollar terms. That's the easiest way to do it. You can do it other ways using the margins and so forth. It's a little bit more complicated. Okay? So let's take a look at this final example. And I don't think that I used I'll add another example to this, okay? So, let's take a look at this example. Okay, if the firm is targeting $125 in net income for next year, how much units must be sold to accomplish this? Okay, well, that's easy. It's very similar to the break even, but in this case, you don't want to break even, right? You don't want your net income to be 0. You want your net income to be 125, right? So your contribution margin first must cover your fixed expenses, which is 500, right? Then you wanted to contribute an extra 125. So let's put this in parentheses. And each unit contributes 60 cents, right? So you divide that by 0.60, and you must sell 1,041 units, 1,042 units. Go ahead and round it to 1,042. So you must sell 1,042 units to have net income of $125, okay? Another example of what we can do with this margin is pricing. I forgot to mention that one, right? So let's take a look at, let's say you know that it costs you 40 cents to produce a, it costs you 40 cents to produce your product, right? And you're thinking, okay, it cost me 40 cents. I don't know what to price it for. I could price it at any level I want because I don't have competition. But if I go too high, demand will probably go down, and if I go too low, I'm going to leave some money on the table, right? So you come up with a margin that you think it's right, and you say, well, my contribution margin that I want is going to be is 60%, right? 60% I want, that's what I want my contribution margin to be. So what should I price it? So you're going to take your cost, which is 0.40, right? And you're going to divide it by 1 minus your cost. In other words, your desired contribution margin, right? 1 minus your, let's see if I got this right, sorry. Okay. 1 minus your desired contribution margin. Let me come here and let's, okay. So you're going to take you're going to take, let's repeat that, okay. You're going to take your cost, which is 40 cents. That's my cost, right? I know that's my cost. So what should I price it? If I want, what should I price my product? If I want a contribution of 60%, well, take 1 minus 0.6, that's my desired contribution margin, and that is going to give me the proper pricing. Okay, proper pricing here is going to be $1. So now I know that I have to price my product at $1 if I want a contribution margin of 60%, okay? And that's the formula for that there, okay? So these are various uses for using the variable costing income statement, and it could be used in other areas as well. Understanding fixed from variable is very important. Why? Because typically variable costs will go to 0 if you don't produce and will increase as you produce, whereas fixed costs behave very differently. You may not be able to get rid of any fixed costs at all. For example, if you get rid of a product or a segment. And so you need to keep this into account when you make decisions like, should I get rid of a product or not? Also, making versus buying a product. Should I make it or should I buy it? Well, you got to understand what your fixed expenses are. How much excess capacity, unused fixed expense you have, and so forth. I don't want to complicate it too much, but needless to say is that this statement is much more useful for managerial accounting than the absorption format, right? So that's why we take the absorption format, which is the one that complies with GAAP, which relates to financial accounting, and we tend to convert it into a variable costing format, okay? If I ask you what costs are in a product, are part of the product cost under absorption, your answer would be direct materials, direct labor, and all factory overhead, right? All factory overhead, all of them, right? As opposed to variable costing, I should have left that chart here, the one that I did down here. The cost for the product under variable costing is going to be direct materials, direct labor, and only variable factory overhead, okay? Only variable factory overhead. From there you get your manufacturing margin, and then you subtract the other variable cost, which is selling and administrative costs, to get your contribution margin, okay? So that's it for this video. I hope it was helpful. Thank you.